Tuesday, the 6th of September, the kids are back to school and the volatility may be coming back as well. As far as today's action, the movement has brought us back down towards this 18-period average of closes. We're looking at a symmetrical triangle. Possibility may occur of lower highs and higher lows, which creates this pattern. But now is a time where things can really start to pick up because Labor Day is completed. Within the 6-hour or quarter day chart, we have the Fibonacci regarding this high as well as the Fibonacci from this low. And we have had two hits today, this morning at around the 42 level. The Fibonacci mark is 42.05, but it's really in or within that area. So simply calling it 42 is totally fine. We do have this rising 5-day moving average. And when you have a rising 5-day moving average, that means that all the sell-offs that may and do occur are guilty until proven innocent. Guilty, of course, of maintaining its current new trend of going lower. So it starts going lower down in here. This is currently guilty as of now. The odds favor that you come down here, you find some sort of level in some way of finding productive support, and then coming back, testing this level, and then eventually, of course, breaking it. Because what is ideal is if you come back here, and if you do decide to find resistance again, is to find the higher low before breaking that level towards the upside. I want to segue into this daily chart. There is no dates within this chart, but there is price numbers on the right hand side. When you see this price action in green, that means the market is in an uptrend. Blue is in a neutral market and red is in a bearish market. What defines what the category of these markets is the Fibonacci lines. It takes the 100-period high and 100-period low and then calculates the Fibonacci from that point. Therefore, the majority of this has been in an upward trend because for the most part, it's been doing very well because it's above this green line. Now, this did occur at around the end of 2008 and on. That's when this starts. And when we see this pattern developing in here, we have a little dip in here and it goes bullish. Another quick little dip, trying to break free, and then it finally does. Therefore, this move was very much, I'm not going to say it was overdue, but it was definitely due. Because you have a long run of making a pattern of higher highs and higher lows. And then you quickly move into a neutral or bearish market. We're going to zoom in on this, so just adjust your eyes possibly. And this is what we see within that crash. Market goes from bullish to neutral, has a brief moment in here where it's bearish and it bounces from that level, stays neutral, and now we're back to the bearish point again. Goes neutral, tries to go bearish, but not really, it just stayed neutral in here. But it's now again trying to break away, and once this thing can finally get into a nice bullish state, this is the energy mana used or required a lot of times for the things to really get going. Sort of like in here, you had this sideways action and boom, it was going. Yes, it was bullish for a few periods, but it was not making a significant pattern of higher highs and higher lows until August of last year. Now let's take a look at this on a long-term perspective. And we're now going back to 1968. And we see it goes from red to neutral to bullish. The bullishness lasted until this sell-off occurred in here. Because you get to a point where you're supposed to find support in here after the move goes from 50. That was going from 50 to 13 or 14. That's not what you normally say. You normally don't say, okay, we're at 50, we're expected to go to 14. No, but that's where the Fibonacci mark happened to be, and it didn't even hold. Thus, it started what turned out to be a long-term bear market, and we can see neutral, bearish, neutral, bearish for a long time. Gets a little neutral, tries to get bullish, not yet. Instead, we got more neutrality, more bearishness, more neutrality, and then this is where it finally gets going in the earlier part of this millennium. Has a nice move, and the 2008 fall never got us bearish. It got us neutral for a small period by going below this green line, and boom, up she goes. And now we have a situation where the market goes to 50 and back down to 32. And I've seen so many people panicking at that point. A lot of people saying, I don't know why I got into silver. I'm getting out. And, well, that was their choice. But when you look at this on a longer term perspective, this is your everyday kind of dip. Going from here down to here. Nothing unusual about that type of movement. And those corrections can oftentimes be very healthy. And we'll finish this off with a short-term view of the market. This is SLV, and this is a 15-minute time frame. There are many more data points, so I've changed it from 100 periods to 400 periods. There's about 7,000 days I'm going through, or 7,000 periods, excuse me. And just like in 1968, you go from bearish to neutral to bullish like this. Have a little bit of a correction in January, and then the market continues to go higher, and there's that correction that we've seen. So it goes from neutral to bearish to neutral, tries to get bullish but can't. Instead, it sticks within this neutral to bearish segment, gets a little more bullish in here, and it lasts for a decent amount of time. We have a little bit of a correction in here. Once this thing gets going, then this is that fuel that I talk about that is needed. But trying to guess when it's going to take place, that can be very difficult to do a lot of times, because the length you can go from point A to point B, you don't know if it's going to be 5 periods or 50 periods for the most part. But what we are seeing in here is how the short term is moving away into this bullish scenario, as I was talking about on, I think it was the daily chart, about that possible wedge. If it does make that lower high and breaks through, we haven't convicted any bullish sentiment by only having short periods within here. Okay, now what this means is when we do move up towards the 50 level, I will be looking for a Fibonacci line like this to actually hold on a retracement. That means maybe it goes up something like this, and then the market dips back and then starts to go higher in some sort of manner. Okay, thank you for tuning in, and have yourself a magnificent week. Bye-bye.